What up, guys, and welcome back to another video. Of course, it's your boy Jay Manchin. Last week, we talked about how Donald Trump wants to put someone in the Fed chair position that would effectively be an extension of him.
I've instructed my people not to do any debt beyond 9 months or so. Get this guy out, and whoever's in there will lower rates. If I think somebody's going to keep the rates where they are or whatever, I'm not going to put them in. I'm going to put somebody that wants to cut rates. There are a lot of them out there.
I mean, he really wants lower rates, mainly to lower the debt servicing cost.
And if we would lower the interest rates by 1 point, we'd pay about 1 point less. That's $300 billion a year. Can you believe it? 1 point. If he'd lower it by 2 points, we'd pay $600 billion a year less. That's for years, 10 years, 12 years, whatever we make it. But we can't get this guy to do it.
Well, considering there are so many ramifications to lowering rates, especially in this environment, I don't think that would be the most prudent thing to do because of all the after effects or because of the vicious cycle that it could start. Cutting rates right now would definitely 100% spike inflation. And if we have an exacerbated effect on inflation from tariff impacts, then eventually costs for companies in terms of their inputs will get more expensive, which means they will start looking for ways to cut costs. And obviously, when it comes to cutting costs for any company, the first thing that goes is what? Employees, exactly. I mean, unless they got one employee. Shit, and even then, you still might get cut. Anyway, and obviously, if that happens, that will leak into housing.
Basically, the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market.
So what he means by that is he can't directly affect mortgage rates, but the things that are affected by the Fed funds rate does feed into what happens with mortgage rates, such as bank lending and the risk appetite for banks depending on the level of the Fed funds rate at that current time. And so, yeah, it closely tracks the Fed funds rate. Now back to the cycle. If unemployment starts to get affected and we see some type of rise in unemployment, rapid or gradual, but big increase, that means that less people will be able to qualify for a mortgage, which obviously equates to demand in the housing market. So that would take a hit. And if that were to happen in this environment, with supply increasing as it is, that would definitely put downside pressure on home prices as it is right now already. So it would just be exacerbated. So bank lending slows, money velocity slows, and obviously that means GDP would take a hit, which means we'll probably go into a recession. Then that will force the Fed to lower rates to the zero bound even further, which is part of the reason we got here in the first place. So that would just cause more long-term problems in the system. If they don't do that, or they already do it and things are still bad, they would have to print money by buying treasuries and giving that money to Congress in order to pass it out in the form of stimulus packages, like we did during the pandemic. Now, that was an oversimplification of the cycle, but it does give you an idea of the implications of lower rates in this environment. Basically, lower rates right now are not actually a good thing, which is why we're not getting them, guys. But Donald Trump is going to do it anyway.
We'll go short term for a year. Let this guy get out of office. Somebody will come in, cut it a couple of points, and we'll save ourselves $7, $8, maybe even $900 billion a year. What is he doing? Why doesn't he lower these rates?
The Fed has no clear reason to cut rates right now. There is nothing clear telling them that they should cut rates, except for the president. And it does at some level depend on the data that they're looking at. But Jay Powell has made it clear that he's not going to be proactive because it wouldn't be the prudent thing to do in this environment because there's too much uncertainty. So he wouldn't even know what he's being proactive against.
But that process is very hard to predict, and we haven't been through a situation like this, and I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
So core PCE in the latest release came in at 2.7%. When I checked Truflation this morning, it was at 2.27%. And the 3-month annualized core PCE came in at 1.65%. And so if you're just looking at that one data piece of 3-month annualized core PCE, then yeah, you could say, oh, this is enough data to warrant rate cuts in this environment. That's one data point. It's showing sticky in every other inflation metric, including Truflation at this point. And obviously the unemployment rate still remains steady, but continuing claims are akin to pandemic levels right now. I will say that. But still no signs of real rapid deterioration in the labor market right now. Look, Donald Trump said himself, the tariffs, they aren't going anywhere.
I had Texas Instruments come in the other day, big company, and he said, we're putting in $60 billion into new plants and new equipment, new everything. Sir, you're going to keep the tariffs, aren't you? Because if I ever took the tariffs off, and we are going to absolutely keep it.
So we can expect more sticky, possibly higher inflation numbers going through the summer.
Goods inflation just moving up a bit. And of course, we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months.
Which will, of course, keep the rates where they are, because the Fed would not want to exacerbate the inflation numbers more than they already are being spiked by tariffs. Well, I don't think we're going to get rate cuts in 2025 unless we have a rapid spike in unemployment, or if we have at least 2 consecutive prints on the PCE, core PCE below 2.5. I think those two possibilities obviously would warrant a rate cut. Maybe they happen at the same exact time, who knows? But they would definitely warrant a rate cut in this environment. Other than that, I don't see it happening.
We are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, meaningfully weaken in a way that was concerning, that would matter for that decision.
Like I said in my last video, I wouldn't be surprised if they decide to hold rates where they are through the end of Jay Powell's term. Jay Powell does not want to be the one remembered as the guy who spiked inflation right before the end of his term.
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.